The Federal Reserve just created a new social safety net for the most disadvantaged and marginalized community among us: Wall Street. It's called the Bank Term Funding Program, and it's basically a permanent bailout that ensures that banks won't lose any money. Here's how it works. Silicon Valley Bank, the 16th largest bank in the United States, collapsed because it bought treasury bonds, aka US government debt, which lost value when the Federal Reserve raised interest rates. Clients at Silicon Valley Bank saw this, got scared, and tried to pull their money out. Seeing people pull their money out triggered a chain reaction of even more people pulling their money out, causing a snowball effect of withdrawals more commonly known as a run on the bank. However, Silicon Valley Bank isn't the only bank that's holding bad treasury bonds. Basically, every bank in the United States holds treasury bonds, and the value of these bonds has plummeted since the Federal Reserve started raising interest rates. US banks were sitting on $620 billion in losses on treasury bond investments at the end of last year. In other words, what happened to Silicon Valley Bank could theoretically happen to a lot more banks. So what does the Federal Reserve do? It sets up this new loan program, the Bank Term Funding Program, which allows the banks to use their treasury bonds as collateral to get loans from the Federal Reserve, which the banks can then pay out to its customers in the event of a run on the bank. The only catch? The Federal Reserve decided that they're going to value these bonds at face value, instead of the much lower market value that these bonds currently have. In other words, the Federal Reserve unilaterally decided that they're going to treat these bonds as worth way more than they really are, because that's the only way they can save the banking system. To put this in perspective for those of us who don't own a bank, let's say you saved up for a house. You pinched pennies and set aside your hard-earned wages to buy your dream house for $300,000. Then the housing market crashes, and all of a sudden, your house is only worth $100,000. Your mortgage is underwater, you're suddenly behind on your bills, and you need money. Instead of what would normally happen, which is the bank foreclosing on your house and leaving you homeless, the bank says, you know what? Not only are we going to lend you money, you can use your house as collateral for a loan, and we'll treat it like it's still worth $300,000. Could you imagine a situation where a bank would ever do that for people like us? But that's exactly what the government is doing for the biggest banks in the country. So why does this all matter? Because people say they're opposed to socialism and support capitalism because socialism is a centrally planned system. But this banking crisis has shown us that capitalism is also a system that has to be intensely managed by the state to prevent it from imploding. The only difference is, under capitalism, the central planners, like the Federal Reserve, manipulate the economy to benefit the banks at the expense of poor people. Under socialism, the economy is also centrally planned, but it's planned to eliminate poverty and put the needs of the planet first at the expense of the banks. The whole dichotomy between big government versus small government is a false one, because governments are not a uniform body. When it comes to war, policing, prisons, and propping up big banks, capitalism has big government. But when it comes to healthcare, education, protecting the environment, or scientific research, these sectors of capitalist governments are microscopic. So the correct way to understand these latest bank bailouts isn't about whether there should be more or less state intervention. Capitalism can't exist without state intervention. The real question is whether a government's responsibility should be to intervene on behalf of elite bankers or on behalf of the working class.